All right, let's take a look at the assignment for round 1C and take a look at the kind of answers that we ought to be able to come up with. So question 1 was, suppose Ferris wanted to reduce its leverage ratio at the end of round 1 by using cash to pay down debt. Okay. The important thing to note there is that when you're using cash to pay down debt, the equity does not change, right? Because your assets are going down, liabilities are going down at the same rate or the same amount, and so the dollar amount of the equity doesn't change. The ratio changes, and that's why we look at the leverage ratio, right? So if we use some cash to pay down a debt, we can actually bring our leverage ratio down. And I believe in this case, Ferris had a decent amount of cash so as to make this a very viable thing. Yeah, let's take a look, and I should have had this up and had them, but it shouldn't take me too long. And anyhow, so the formula, and it gives you the formula right in the Courier. It says that our leverage is equal to our assets divided by our equity. Okay. Well, the leverage I've given you. I've said okay, and I guess I actually gave you the formula there too. But so we're shooting for a leverage ratio of 2. Okay, so 2 then is equal to our assets divided by our equity. And again, our equity isn't going to change. Didn't change. If we took cash and paid down debt, all right, let's go down to that balance sheet. Okay, there's the balance sheet. So Ferris, if we took $10 million of cash, that would lower its current assets by $10 million, so that'd be 52. The total assets would come down by $10 million, so that'd be 51. But our total liabilities would come down by $10 million also, so those would go down to. This, I said 51. That should be 61, and then this would come down to 59. But our equity would stay exactly the same, and yet our ratio would change. Okay, so our equity stays the same, but anyhow we do the math, and so 2 is equal to our assets divided by our equity. Okay, so multiply both sides by 64,544,000, and you come up with 129,088,000, and that's actually what our assets should have been. And so I should have calculated then how much that change is. So we would have because what our total assets were, our total assets were 134,233,000. So we would take, it's not going to work real good for me. Well, what a pain. So it would be 134. What did I say? 233. 233 minus our 129,088 equals, whatever that equals, about 5 million and something. So 233 minus 129,088 equals 5,145,000. Yeah, let's make that dollar sign instead of a percentage. There we go. Sorry, that's what I should have done to complete it. So that's how much we'd have had to pay it down by, is $5 million. So we could have used $5 million of our cash, paid down debt, current or long term, wouldn't matter. Okay, that wouldn't make any difference in terms of the ratio that we're looking at. So question 2. How much additional income did Erie earn in the low end, product ebb only, because they had a couple products that sold in the low end. I think their traditional product also sold there. In other words, net after taxes, how much more did Erie make because ebb sold above its potential? So we got 13.8 minus 9.3 equals 4.5%. That's how much extra we sold. Okay. So we take that 4.5% times the 10,089,000 total demand for the low end. Okay, so we gain sales of 454,005 unit sales. If you round it off and drop the 5, I'm probably not going to worry too much about that. So that's how many extra units we sold. Now I just did it this way. I figured the gross profit per unit by taking the price minus my variable cost per unit, which is, again, we can find that down here in the production analysis. So ebb 23 is my price, 7 plus 803. There's my variable cost, so 1508. So my gross profit per unit then $7.92, just the 23 minus the 15. So then I can take that gross profit times the units, gained unit sales, and I end up with an extra gross profit of almost $3.6 million. Now I have to apply my tax rate. Okay, my tax rate's 35%. Where do I get that? I think it's in the guide. Okay, and so my taxes end up being $1.2 million. The other way you can calculate the tax rate, it's what I did, is I just went to, sorry, I have to go up, but I went to any one of the teams, a little easier when they got positive taxes. So I took, let's say, Team Ferris, and their taxes were $1.595 million, but their earnings before taxes would be the 11.992 minus our interest, right? We get to subtract out our interest. So that's about $4.5 million, somewhere in that neighborhood. I divide the 1.6 million or 1.595 million by the difference there, 4 million, about 4.5, and I came up with 35%. So I did that instead of going back and looking at the guide to figure out that 35% was the tax rate, and that's consistent for all teams. Okay, so then all I have to do is subtract my taxes from that gross profit, and they should have netted an extra $2.337 million. Okay. 3, Chester is forecasting sales next round in the high-end segment. It's estimating that it will sell 490 units of SID, its high-end product. Chester wants to have an extra 10% of units on hand above and beyond its forecast in case sales are better than expected. It would risk the possibility of excess inventory carrying charges rather than risk lost profits on a stock out. Taking current inventory, we have to take that into account. What will Chester's production have to be in order to have a 10% reserve of units available for sale? And I said there's bonus if you include the adjustment. So 490 is what I want, right? But I want 10% more than that, so I got to take my 490 times 1 plus 10%. So 490 times 1.1 is equal to 539. That's the total units that I need to have. Okay, but I have inventory on hand of 129 units. Be 129,000, right? Okay, so I subtract that from my 539, and I need to produce 410 units. Boom. As simple as that to get the questioning correct. If you do the adjustment, if you look when you guys do your production, okay, when you do your production decisions, it would take me a while to get there, so I'll avoid that. But when you look at your production decisions, you'll note that there's an adjustment factor in there. And what that is, it should be 1%. Hope I got that right. I'm sure I do. That's taken off and basically saying that when we produce things, we have a certain amount of them that don't meet our high quality standards, and so they get tossed away, and we calculate that amount to be 1%. So to make that adjustment, I can just take the 410 that I need to produce and divide it by 0.99, and that gives me 414, a few extra that I need to produce to make sure that I ended up with the 410. Okay. 4, what was the cost, total expense, fee plus interest of Digby's emergency loan, or Erie? And I did Digby, I believe. Yeah. So Digby had an emergency loan of $9.1 million, roughly. Uncle Al's fee 7.5%. That's well established. So that cost $682,000. Now, this rate, I thought sure that was given to us, and so I may be wrong about that. Maybe you guys found it. I kind of read back through the guide and did a little other information. I couldn't find anything that specified what the current rate was. Now I could back into that. That would take me a long time. What you have to do is look at their interest and then back out all the interest that they pay for their long-term debt. that would take a little bit of calculating. If you did that bully for you, I'll probably give you some extra credit for that. So instead, I applied a rate that I thought was kind of normal. So I'm going to be very, very liberal in my acceptance of what you guys might have used for a rate here. Hopefully you used something. I used 10.5, which is prime plus 3. That was kind of a normal rate. We used to charge at the bank, and prime rate's given to us. But so I took the 9.1 million, multiplied it by that. Again, if you use some kind of rate in there, they'll probably be pretty liberal. But I came up with $950,000, so a total of about $1.6 million, right? Cost for a $9 million loan. So that's a lot of expense. Now, that's all tax deductible, though. That's all interest and fee, which is tax deductible. So I guess there is that. Not that I'd call that an advantage, but there you have it. So assignment for round 1C.